You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello and welcome back to the Infinite Banking Mastery Podcast. Thought I would touch today on something that doesn't happen that often, has happened very seldomly in my career, but it did happen recently. So I thought I would share on the topic of feeling like you need to close your policy right away within the first few years, or maybe even the first year. If you have something come up, something happen, an illness, a job change, a job loss, something that happens that feels catastrophic, or maybe it is catastrophic and you're not sure what to do. You just started your policy. Maybe it's 1 year old or a few years old or not quite a year old. And so I thought I would cover just some options and talk it out with you. So, it doesn't have to mean complete destruction of your policy. There are things that you can do. As much as we desire and hope for a life without any hiccups and expect to be able to fully fund our new whole life policy, sometimes life throws us an obstacle. Of course, things happen, life happens. You just have to be able to work with it from there and do what you can. Maybe you were to have a job loss, or maybe your spouse loses a job, or there's a disability, or even a death that you weren't prepared for. Maybe you simply got led astray by another advisor who told you you were nuts and you are supposed to be buying term and investing the difference. Well, there are certainly things that you can do to not lose the money you've already put into the contract. Because if you decide to terminate the account, you will have a loss if you terminate the account in the first year or in the first few years, usually up to 7 years, you easily will have some sort of loss. So here are some things that you could do if this was to happen. Maybe it will ease your mind going into this, and you're thinking, okay, there are some things that I could do if something catastrophic and unexpected were to happen. First of all, you have a 2-month grace period. So at least the companies that I work with have a 2-month grace period. So if you can't make your premium on the day it's due, you do have 2 months to fund that, whether you're funding an annual premium or a monthly premium or quarterly or semi-annual, you have 2 months to send that payment in. Another thing you are able to do is change your premium mode. So if you started off paying in annual mode and all of a sudden this large payment is coming closer, it's looming, or you're thinking about it because something catastrophic just happened, once your payment date gets here, you can change your premium mode. So you can switch to monthly and then pay for as many months as you need to or want to. And then maybe your situation changes and you can either continue on monthly, or you could switch back to annual and fund the rest of the year. You could drop your paid-up additions for a year or two and just fund the base premium and fund that premium again monthly, or in a different kind of premium mode if you were on annual and that would become too difficult. You do have the option of not paying that paid-up additions rider in year 2 if you simply can't, or you have the whole year to get that in anyway. So maybe the first year you funded everything at once, the base premium, the paid-up additions rider on an annual basis all at once. But year 2 comes along, or it's approaching, or even year 3 or whatever in those first few years, and you're thinking, oh no, I'm not going to be able to pay that large payment. Remember that your paid-up additions rider is flexible. It's not required to be paid on your anniversary. So you could make that change and not worry about that portion of the premium. And then you have the base premium that you could fund in full if you can, or change to monthly. And either of those methods, you have an extra 2 months to fund that premium. A third option would be that you could take a loan against the policy for your premium payment. When I'm talking to clients, a lot of people aren't aware that they can take a loan against the policy to fund premium if they absolutely need to. Of course, it's always going to be better to fund that premium yourself directly each year and out of pocket. But if you can't, you can always lean on being able to borrow against the policy to pay the premium to help you get through a hard time. Or if you were to switch to monthly, let's just say you switch to monthly premiums because you don't want to borrow against the policy for a full annual premium. You could switch to monthly and then you could borrow against the premium for however many months you need to get through that hard time. And then when you're back on your feet, you can replenish that money. You can replenish it on a monthly basis. You can pay it all the way back. You can do whatever you need to do to get that replenished on your terms and in your timing. Maybe you happen to have another policy that has available cash value that you are able to borrow against to help you get through this short-lived bump in the road. You have another policy you can borrow against to help pay for the policy's upcoming premium that you're worried about. Even you can have the company will move funds from one policy to the next and pay that premium directly so you don't even have to worry about receiving it and paying it. That's another option if you have more than one whole life contract with cash value available. If none of these options will work and you're really still stressing, we can also look into the possibility of simply lowering your premium altogether, just lowering everything. We can always look at that with the company and see what we can do. Of course, we're always trying to balance and keep from becoming a MEC or having your policy become a modified endowment contract, but that is another option. And finally, I think more like a last resort, but still better than completely terminating your contract, would be to pay up the policy. You can always ask the company to use the dollars you've already paid into the contract to do what's called paid up, reduce paid up. And they use those funds to pay the policy up so that you'd have no more premiums going forward. So it would stop all your premiums, and it also would drop your death benefit significantly. So whatever your death benefit is, it's going to drop significantly because it's going to be based on whatever dollars you have in the account. However, your death benefit will still be more than the cash value that you have in your account. So it's still going to be better off. Once you have that significant drop in death benefit, then the death benefit will continue growing from there and your cash value will just continue to grow. Now, if you were to reduce pay up like that and it was under 7 years, you're going to have a modified endowment contract that it will become one of those, but it still will grow efficiently for what you've paid into it. It will grow efficiently. The death benefit will grow. The cash value will grow. You'll be able to access that cash value. Now it's going to be on a taxable basis, or at least the earnings will be on a taxable basis if your contract has become a modified endowment contract. But you still have access. You can still borrow against it. You can still do similar things that you could have done with your IBC style contract that was tax-free, but still everything will grow and it's not going to be a terrible thing. It will still end up being a useful asset. Now, of course, there's other things you could do, other ideas and options out there. Maybe you have money that's just sitting somewhere that you had earmarked for something else or hadn't planned to use for your policy, but it's possible that you could use it for your policy, fund the premium, and if you need to get the money back where it was, or if it really bothered you to have the money moved to your policy and you needed to have it back, or you wanted to have it back in the investment that you took it from or the place where it was sitting, you could easily run it through the policy and put the money back, depending on how long you've had your policy, if you're out of the startup cost time period. If you're still in those startup cost years and you move money from another account and you want to run it right through and pull it right back out to put it in the account that you pulled it from, and you're still in your startup cost years and you're only paying the base premium and no paid up additions, you may not have access to every single dollar you just paid into the contract just yet to borrow it back out and do that. But you still would be pretty close probably, or we could create a plan, something around that to get you through that difficult time. Another thing you could do, you could reduce outgoing payments to other debts to other banks and lower those payments that you have. If you haven't done that already, you could lower those payments. Maybe you have a minimum payment that you're required to pay and you're paying more than that. You could reduce that and use that extra money to help fund your policy through that time period. Or maybe you have a home equity line of credit that's there and you could borrow against that, borrow from your HELOC for a period of time just to get you through this hiccup and then pay the HELOC back. So there are lots of ways to keep you from completely losing the startup costs of your system, which is what would happen if you were to stop your policy in those beginning years. In those startup years, you would lose some money because you would not get access to all the dollars you just paid into the contract. Now, there's no surrender charges with a whole life policy, so you don't have to worry about that. But until you get past those startup years, you wouldn't get access dollar for dollar to everything you've paid in because, of course, you've been covering the cost of the death benefit. This is still a life insurance policy, and you're paying for that cost of the death benefit. Maybe in the event of a hardship for you, depending on your financial picture, there's a plan we could make where we would be able to get you through at least those first 7 years so that you could then pay up your policy. If at that time you needed to, maybe at that time you're good to go and you can just keep funding as planned. But if it turns out you still needed to stop funding your contract, stop paying premiums, we would be able, or we should be able to stop funding at year 7, and then your policy would continue to grow, both the death benefit and the cash value on a tax deferred basis, and you'd be able to access those dollars income tax free. Now, I just want to point out, whenever you reduce pay up or pay up a policy, the death benefit will drop at that time. So it would drop first if you were to stop paying, and then it would continue to grow from there. There's just all sorts of things we could do. And depending on how long you've had the policy, there are other ways to help out if you're having a hardship that I did not cover here. If you were to become disabled, as in unable to work due to an injury or illness, then there would be no problem if you had the Waiver of Premium rider on your policy, which I usually always recommend. Then you wouldn't have any problem because you would not have to pay that base premium during that time when you're unable to work. Once you were able to work, then you could start funding premium again, but you would not be required to while you were disabled. Well, enough talk about the bad things that could happen. If you're in a positive frame of mind, ready to get started and would like to work together, feel free to reach out to me. You can reach me at Valerie@alphaomegawealth.com. Take care and have a great week.
This is the podcastfactory.com.